Yields are slipping past 5% after Fed Chair Jerome Powell re-emphasized the need to see more data before they have the confidence to cut rates.
The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. And I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path.
Our next guest thinks while we stay higher for longer, there might be some opportunity in the fixed income space. To break it all down for us, Leslie Falconio, UBS Global Wealth Management Head of Taxable Fixed Income Strategy, is here. Leslie, good to talk to you today. We saw the markets push higher in a significant way yesterday on the back of those comments from the Fed chair. The yield's pushing higher today, but I wonder if anything has changed for you, at least in your outlook, given the messaging coming through from the central bank.
You know, it hasn't. And I think the important point is that the market was very hawkish going into the Fed meeting. I mean, they had priced out a tremendous amount of cuts down to about one cut at the end of the year, 30 basis points. But it wasn't just about 2024. They also had a very shallow cutting path into 25 and 26. And this left that terminal rate or the neutral rate well above 4%, which we deemed, and we still deem, a bit too high. And I think that because the rumor of this potential hike was so permeating the marketplace, and they asked Chair Powell 5 different times about whether or not that would be the path. And I think he actually sort of eliminated that, probability. You can never say never, but highly unlikely. But he also, acknowledged that inflation is not making the progress that they had hoped, and they are going to still be data dependent. And more than likely that high for longer might last a little bit longer, but he clarified the path of cutting. And I think that's really the important part here.
Leslie, do you believe that the Fed is going to be able to declare victory on inflation, and will that come at some point this year?
Going to the 2% target, and I don't even think they have that in their own projections when you look at the S&P. I think they need to see, continued progress lower, right? They want to see this disinflation trend, and they just don't want to see an acceleration, right? It doesn't have to be at 2% before they cut, nor do we think that it's going to be at 2% for quite some time. But I do think they just need to see it move in the right direction. So I think that in terms of that commentary, he made that perfectly clear. He also emphasized how far they've come. How far they've come in, labor loosening, how far they've come with inflation coming down versus these pre-pandemic levels. This first quarter data has just been a bit disappointing. And he also mentioned the nuances that we have with owner's equivalent rent and auto insurance and those things that have really kept inflation elevated. But I do think that when we do believe that inflation trends down in the second half of the year, we think growth will also trend down in the second half of the year while remaining above trend. That's why we lean more towards that soft landing camp. But he just can't see a reacceleration. And I think that is what will really change his tone, reacceleration for a sustained period of time.
Leslie, one of the things the Fed chair wasn't asked about yesterday is about the external factors, things that are not necessarily in the Fed's control. You look at what's happening overseas, maybe, potential developments in Ukraine. We saw how it played out, at least in the energy market, in the initial months of the conflict there. I mean, how are you thinking about that? We sort of talk about it as if this is about the Fed policy taking hold and really trickling down. But there are a few things here that could be X factors, keep inflation sticky.
Well, I mean, I think that's a great point because there's a lot of things that haven't been in the Fed's control, right? Hiking interest rates is not going to alleviate supply issues, right? So, or when it comes to the say geopolitical risk, the risk there, say if oil spikes, it has, he's mentioned this, and we believe this as well. It has to be for a sustained period of time. So if it's something that occurs over 3 to 6 month period, I don't think that changes the outlook. But I think one of the things that he is a bit surprised as are we to a certain extent, that he still calls the current policy rate restrictive, but we know that these higher interest rates hasn't had really that impact on the consumer as one might anticipate, except for, say, the mortgage rate or the residential housing market. But as we know, most of these consumers locked in at 3.5%, 4%. So I think that having control is taking a little bit longer than what he thought. And I think the fact that they've been on hold for 10 months at a peak rate of 5.25%, 5.5% hasn't had the impact in terms of curtailing demand to the extent to which I think he thought it would. And we feel the same way. But we do expect demand slowly to decline. We do expect the labor market to start to loosen over time. But I do believe that he's in a situation where inflation probably won't drop as quickly as he would like. And if he keeps rates higher for longer, and this headwind to demand starts to accelerate, you could see that unemployment rate go above 4%. And I think through his eyes, that's when a problem could occur, and that's when they're really going to start cutting.
Leslie Falconio, who is the UBS Global Wealth Management Head of Taxable Fixed Income Strategy. Leslie, thanks so much for joining us here this morning.
Thank you.